Late Thursday afternoon, with less than an hour left in the trading day, President Trump made an announcement that sent the mortgage market into a frenzy. And if you've been waiting for rates to move, this changes everything. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This week brought us the kind of market disruption we rarely see. Thursday at 1:30 p.m. Pacific time, President Trump directed his representatives to purchase $200 billion in mortgage-backed securities. And here's what you need to understand about this announcement. It's not some off-the-cuff remark. Fannie Mae and Freddie Mac currently have $202.9 billion of room on their balance sheets before hitting their regulatory cap. That means the $200 billion figure was carefully chosen, and this is absolutely serious. The mortgage bond market reacted immediately. The current coupon mortgage-backed securities, MBS, tightened 6 basis points in minutes, backed by real transactions. These weren't paper moves. Dealers were actually trading billions of dollars at a time of day typically reserved for heading home. When you see that kind of activity in the final hour of trading, you know something significant is happening. Now, Friday's jobs report came in mixed. The market expected 60,000 jobs created in December, but we only got 50,000. And where did those jobs come from? The same two places we always see: healthcare and social assistance, plus leisure and hospitality getting a December holiday boost. Take out healthcare, which isn't really impacted by economic conditions, and you're basically flat. But here's what really matters. November and October were revised downward by a combined 76,000 jobs. October went from an already weak negative 105,000 to 173,000 negative. That's not a rounding error. That's a significant downward revision. And you look at where job creation has been over the last 6 months, we've averaged just 22,000 jobs per month. Compare that to 2024 when we averaged 144,000 per month. The unemployment rate did fall to 4.4% from a revised 4.5%, but that was driven by a decline in labor force participation of 46,000 people. When people stop looking for work, the unemployment rate falls, but that's not exactly a sign of strength. Here's the data point that should concern every financial professional. The New York Fed survey of consumer expectations showed that the perceived probability of finding a job if you lost your current one fell to 43.1%, a series low, and the expected likelihood of receiving at least one job offer in the next 4 months dropped to 18.3%, the lowest point of this cycle. So what does all this mean for your clients and your business? The Trump administration's $200 billion MBS purchase program should help narrow the spread between mortgage rates and Treasury yields. We've already seen that $50 billion in purchases over the last 7 months it's tightened the spread by about 50 basis points. Even with diminishing returns, another 50 basis points of tightening is possible. That means today's rate of around 6% could potentially fall to around 5.5% without any movement in the broader bond market. And this is important, don't expect an overnight miracle. Volatility will be significant as traders figure out implementation details. Some lenders' rate sheets won't move in line with what you've come to expect. The bond market needs time to absorb this. For your clients considering a purchase, here's what matters. If rates do come down, demand will increase. But builders can't just snap their fingers and finish homes. Housing starts are around 1.2 million, and builders have wisely slowed construction to meet current demand. When rates drop and demand picks up, there will be more buyers than available homes, at least in the short term. That creates opportunity for price appreciation. This is where having the right monitoring tools becomes critical. At rsrlinks.com/keysteps, that's rsrlinks.com/keysteps, your clients can access comprehensive financial monitoring, credit monitoring, identity theft protection, and budgeting tools all in one place. When market conditions are shifting this dramatically, staying on top of household finances isn't optional anymore. And speaking of household financial health, this week we're highlighting some critical tools that every one of your clients needs to see, particularly in this uncertain economic environment. First, going uninsured to save $400 a month cost this family $18,000 in one day. When job security is declining and people are looking to cut expenses, insurance is often the first thing they consider dropping. This case study shows exactly why that's a dangerous decision. Second, warning, your landlord's insurance won't cover this. For your clients who rent or have rental properties, this is essential information that could save them from devastating financial loss. And third, what if you could stop fighting about money by this time next month? With financial stress increasing, and we just talked about those job finding expectations hitting series lows, couples need tools to get on the same financial page before stress turns into crisis. All three of these resources are available either to the right or below on this dashboard, along with the agent tip of the week. These are tools you can share directly with your clients or use in your own practice. Looking ahead to next week, Tuesday brings us December CPI report. This will be significant. The Cleveland Fed expects the core year-over-year reading to hold at 2.6%. If inflation comes in tame, that'll provide relief to the bond market and could shift some Fed members who keep worrying about inflation. Wednesday brings retail sales data and existing home sales for December, and we'll get producer price index numbers. These will all help paint the picture of where the economy is actually heading versus where people think it's going. Bottom line, strategy beats rate always. But right now, strategy means understanding that market conditions are shifting rapidly and your clients need to be positioned accordingly. Get them set up at rsrlinks.com/keysteps so they're monitoring their financial health while these changes play out. Have a great weekend, and we'll speak to you again next week.